For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Okay, thank you for joining. Hey, it's Managing Your Financial Future, as that nice announcer just said. And welcome back to the podcast. Johnny Dean, your podcast host, Professor Rick Plum. As I have to say every time, for compliance reasons, certified financial planner, professional, and accredited wealth management advisor. Rick, I appreciate you joining us today. I always have this little window of time where I can grab you for a podcast, in between talking to clients and talking to other financial advisors. You're a busy guy.
I try to be. Keeps me out of trouble that way.
Well, it does, as we say, keeps you off the streets. But today's topic has to do with bonds. And we haven't talked about bonds as a single topic for quite some time. And I wanted to go over them again because here in, it was in September, mid-September, not long ago, there was a rate cut, which we don't see nearly as much of anymore. Rates have been fairly steady, I think, since probably 2023. Somewhere in there. So people haven't thought a whole lot about interest rates. But with the 10-year in the low fours right about now, people still tend to think of this as high. And even the folks who are sort of controlling interest rates tend to think of 4 as somewhat high. Now, Rick, if we go back historically, the 10-year, which is kind of a benchmark. I mean, 4 is kind of on the medium to low side.
But you're also throwing in some crazy years like the 80s and where it got a little out of control. And that's when we kind of came into the world of finance, looking at housing and things of that nature. And so our initial reaction was, wow, 12% is kind of normal. But you take somebody who is maybe 40 or 50 at that time and is like, this is ridiculous. Yeah. It should have been like 4 or 5% because that's what historically they were back in the day.
Well, it's funny because there's so few people, relatively speaking, few people who even remember these 12% interest rates from the early 1980s. I mean, and anybody who's in finance now, who's in their 20s or 30s, tends to think of interest rates as being high when it's 4%, and certainly it's more than we had over the 10 or 12, 13 years since the lowering of interest rates back in 2008, 2009. So anyway, what I'm going to talk about today, because they did cut them a little bit, and I don't know, we're not going to talk about where interest rates are going to go, certainly, because that's a futile...
Because we don't know.
We don't know. And if we're wrong, as we probably will be, we'll look stupid if you try to listen to this, a year or two from now. But I do want to talk about bonds in general. And I want to talk about, this is a little bit kind of an educational thing, I guess, more than anything else, although it does tie into strategy. But it's important to note, because I was listening to some financial channel, some obscure channel, and they were talking about these people who are doing it yourself. And they say, okay, well, 60% stocks, 40% bonds. I'm going to do that as I'm retiring and getting into the age of 60s or whatever. And I'm going to stay 60% stock and 40% bond. I thought, okay, well, whatever. Maybe you've thought about that. But when you're talking about, it's one thing to pick stocks, fine, mutual funds, maybe that's easy. But bonds, I mean, I think you need to understand how bonds work, because there are about 10,000 questions that go along with this when you're trying to pick bonds and put bonds into your portfolio. So Rick, I would like you, if you would, talk if you can, give us in concise terms.
Sure, no problem.
How bonds work. Just start with the basics, and then we'll kind of move off from there.
Well, a bond is a loan. You are loaning money to the entity that's issuing the bond, if you're buying it directly from that particular entity at original issue, it's a loan. And the contract of the loan says that the issuing company, government agency, whatever it is, agrees to pay you X amount of interest over a specific period of time. And at the end of that specific period of time, they promise to give you the principal, the face amount of that bond back. So if I'm buying it directly from the company original issue, let's say it's a $100,000 bond, but purely making up numbers for ease of math. I give them $100,000. They promise to pay me 4.25% for the next 5 years, and they usually do that semi-annually, not 4 1/4 semi-annually, but they break it into 2 payments each year. And then at the end of the 5 years, they promise to give me the $100,000 back.
Mm-hmm. Yeah.
Where they become tricky is most bonds purchased today are not purchased from the company or the entity that is issuing the bond. They're being traded on the secondary market. Just like when I buy a stock, typically I'm not buying it from the issuing company. I'm buying it on the secondary market from somebody who's selling it, from another individual, another company, that not the issuing company. So bonds are very similar. The bond market is significantly larger than the stock market as well.
Right.
And there are lots of different kinds of bonds. And bonds, just like stocks, face volatility. Now, how could that be if they promise to pay me a certain rate of return and they promise to give me back my interest or my principal at the end of it? Well, first risk is the issuing company. Is that company a good risk? Are they going to pay you back the money at
or
the
even
end
a
of the
government
maturity?
agency? I mean, you could even say the same thing about local and
municipalities
maybe not state,
and such,
but certainly smaller governments. Yeah.
Well, I mean, there were some famous local municipalities, a couple in California, I remember back years ago, that defaulted on some of their bonds. And so we have to, the first risk is, will the bond pay its interest and pay its principal back at the appropriate time? But you can look at the issuing company. So if you're getting a treasury, hopefully we have no risk with treasuries.
No.
But we have to make sure that the company, the issuing entity, is strong enough to make those payments. But even then, let's say we have a super high quality company, we have no fear of that company going and not making its payments, or we're buying treasuries. We have no fear that the U.S. government is going to make its obligations, pay its obligations. Does that mean that a bond is perfectly guaranteed? Well, it is if you hold it to maturity. But what if I've got a 10-year bond, and let's say I develop a need for more than just the interest in the 6th year, the 5th year, somewhere before the end of the 10-year period of time. And I say, well, I want to cash in this $100,000 bond and because I need the money for something. And I go back to the big company that issued it and say, hey, give me my money back today. And they say, nope, we have a contractual obligation to pay you back at the end of the 10-year period of time, and you're not going to get a dime sooner. And so you then look around and say, John, hey, I got this great $100,000 bond here. Why don't you buy it from me for $100,000? And now we introduce a certain amount of risk, because what John or anybody else will pay me for that bond depends on what interest rate that bond is paying. Now, if I bought a bond in 2020, if I bought a treasury in 2020, it was probably paying about 1/4%. It was maybe 1%, and so it's going to continue paying that 1% for the next X number of years. John, being a smart gentleman, says, why would I give you $100,000 for today for a bond that's going to pay me $1,000 a year for the next 6 years, when I could just go out and buy another $100,000 bond from somebody else that's paying me 4%, 4.5%. And so for me to be able to get John to buy my bond, for me to be able to liquidate my bond, I have to lower the face amount. I've got to drop the face amount so that the return that the buyer, in this case John, in the secondary market, will experience over the remaining years of the bond's life is equal to what he could get with a new bond being issued. Mm-hmm. So I may have to, so if it's only paying 3 or 1% in a 4% world, that's 3%. That means I need to make up 3% a year for the remaining 4 years of the bond. So I've got to discount. This is simple math. It doesn't work exactly like this, but the formula is too complicated to go over on the air like this. But basically, I've got to reduce my bond value by 12%, because that's the 12% that's going to be made up over the next 4 years, so that John realizes a 4% rate return over those 4 years.
So in other words,
1% from interest and 3% from appreciation.
Yeah. So this $100,000 that you gave for this bond,
it's worth 88.
I'm going to give you $88,000 for this bond. That way, my $88,000 is producing what I could have bought with
you
on
get
a dollar
4%
basis.
return. You got 3% in appreciation, 1% in interest. You get 4% a year.
Yeah.
Now, the math doesn't work out exactly like that, so don't hold me to the exact math. As I mentioned, the formula is it's a pain. But that's the concept behind it. Now, that discount, if the bond matures in a year, I don't have to discount it 12% because John's only missing out on 4% for 1 year. Or he's only missing out on the 3% of interest for 1 year. So I only have to discount it for 1 year of interest lost. So I may discount it to 97 and a half or somewhere in there to get John to buy that bond. But when we're buying and managing a bond portfolio, we have to look at what is the worst case scenario that can happen and when will that bond mature. And most of the time, especially when we're talking about buckets, and come on, we live and breathe and bleed buckets here. We use bonds quite a bit in bucket number one, but we're doing them in a way that if I need $50,000 a year, I have a bond, I have cash for the first year. I have a 1 year bond that matures 1 year from now for $50,000, assuming I've got high quality bonds. That $50,000 will be available and it will mature and now turn into cash. I don't even have to sell it. It just matures. And now I have the cash for the second year. I have a 2 year bond for another $50,000 so that 2 years out, I've got another $50,000 of cash done. But I know exactly what I'm getting and I'm not risking the ups and downs and having to sell something before it's due, before it's matured. And so we're looking at, that's why, and a lot of times when we're buying bonds today, rarely are we buying brand new issued bonds. We're not buying T-bills or T-notes. We're usually buying everything on the secondary market. And what I'm buying today may have originally been issued as a 30-year bond, but it was issued in 1997, and it's going to come due in 2027, 30 years from issue. But I'm buying it today for the remaining 2 years. It's only got 2 years left on it, so I'm looking at it and pricing it based on that 2 year. But the interest rates in 1997 may have been quite a bit higher than they are today. I'm sorry, I don't remember the bond interest rates in 97.
I think they were higher, come to think of it.
I think they were, but I'm not going to guarantee that.
They weren't like the early 1980s, and they weren't like the early 90s. I think the 90s were also, like 1990 was pretty high. But yeah, they were still probably higher.
In 1997, that 30-year bond may have had a 7 or an 8% interest rate. Well, guess what? I'm not going to be able to buy a $100,000 7% interest rate, even with only 2 years left, for $100,000 because I can only get 4%. So I would actually have to buy that one at a premium. I'd pay about $106 for every $100 of face amount. I'll lose 3% in value each year, but I'm gaining 7 or 8% in interest every year, and it all comes out in the wash. Then I'm going to get about a 4% rate of return, or whatever the current rate of return is. So when we're buying bonds, we're looking at a couple different things. We're buying them at a premium because the interest rate is a lot higher today than the interest on the bond is higher than what we get on the current bonds, or we're buying them at a discount. Because the interest rate on that particular bond for that remaining time is lower than what I could get today.
Yeah, what you're describing, is called yield to maturity. Now, that's one of those phrases that you hear in economics class, and it's not that.
Who's teaching the course here? You or me?
I want to make sure that we get this all in the allotted time that we have.
Right. So the way to value and the way to kind of compare apples to apples instead of looking at all these different factors is a mathematical metric called yield to maturity. Yield to maturity takes into consideration the total return between today's price and the ultimate maturity date of that bond. So if I'm paying a premium but it has a high interest rate, it's taking all those things. It's taking the fact that I'm going to lose some premium over the next X number of years, but gain some interest, and so that will give me my true, basically I'll call it my all-in total return for that period of time. So yield to maturity allows us to look at bonds with different interest rates and different premium discount structures to say that this yield to maturity is an appropriate one for what I'm trying to accomplish. And I don't have to then go back and say, well, I'm paying 106 and it's going to mature for 100 and it's paying. Just look at the yield to maturity. Also, there is something called a call factor. Some bonds have it. If the interest rates are fairly high and it has a call, it's likely to be called away. The company that issued it may have issued a 30-year bond, but it has a call at 10 years. And now we're 8 years into it, so they could call it in 2 years, meaning they can pay you back a specific predetermined amount of money if they want to kind of refinance their debt. And when interest rates are higher, a lot of companies will put these call features so they can call it back and reissue it as a lower interest rate, saving the company money. So we're looking at yield to call or yield to maturity. And now, if your interest rates are at 1%, your yield to call doesn't matter because they're not going to call that. They want that 1%, right? So, but we're always looking at these types of things. But when we're building bucket number one, we're looking to create structure that, so we look to get rid of any company risk, the risk of going broke and not paying their payment. We try to get rid of interest rate risk by buying laddered and maturing at the same time, so we don't have to sell something before it matures. But we're also looking at some other things too. We're looking at taxes because not all bonds are taxed the same way. We're looking at the security. We're looking at state taxes versus federal taxes. All of this comes into play, and we're trying to develop portfolios so that we're reducing the amounts of risk, but still getting as good a rate of return as we can for the appropriate time horizon that we're dealing with. I don't like 30-year bonds because I don't want to be in a bond for 30 years. But I also don't like stocks for 1 year or 2 years or 3 years or 4 years. I like bonds for those periods of times.
Well, unless you're
different needs for different times.
Unless you're back, earning 12%, I might want to keep that for a while. But that's probably
back in the 80s. If you could get a 30-year 14% Treasury, you were making some good money over time. And then when the interest rates did come down in the 90s from where the 80s were, you could sell that bond if you wanted to. Instead of getting your 14% for the rest of the time on the face amount, you could probably sell it for like $140, $150 for every dollar you had in it. And so depending upon what you're trying to accomplish.
Well, now, for people who are there's a lot here. There's a lot of information here, and I want to impart this to people who say, "Well, heck, I could probably just do this kind of stuff myself." But
fun.
When people say, "Okay, Rick, I'm going to do this myself. I'm going to buy some exchange traded funds or something index funds, whatever it is on the stock side, and I'm just going to buy some bonds." But I mean, what
kind of
bonds are they? What are they buying?
Corporates? You buying treasuries? You buying municipals? I mean, we have people come in and say, I want municipals because I want tax free municipal bonds. The interest that is paid is tax free, but they also have a lower interest rate than a corporate bond or a treasury would have because municipalities know they don't have to compete with the interest rate because they know that it's tax-free. So when we're looking at municipals, corporates, treasuries, or CDs for that matter, we're looking at what's the spread between them. If I have an equal maturity, equal risk municipal bond to a corporate bond, and the corporate's paying 4.5%, but the municipal's paying 2.5%, that's a 40% swing. If I'm in California and I'm in the 37% tax bracket federally and the 13% tax bracket state-wise, that's a 50% bracket. That means the municipal is actually very attractive because I'm looking at what do I keep after paying all my taxes. Mm-hmm. If I have 2.5% after paying my taxes because I didn't know any taxes on it, that's 2.5%. But if I have 4.5%, but I lose 50% of it to taxes, now I've only got 2.25%. That's less than in my pocket than the 2.5%. The municipal makes sense. We do the same thing with treasuries. Treasuries for states that have state income tax are state income tax free. So what's the spread between the treasury of equal maturity? Now we can't technically say it's going to be equal risk because the U.S. Treasury basically is risk free. That's what we think. But a very high quality company, not at risk of defaulting. What's the difference between the Treasury and a CD, which is FDIC insured? So, and I'll look at this a lot for when we're laddering bonds. We're not just necessarily looking at bonds. We're looking at CDs. We're looking at anything that has a guaranteed structure to it. But we're looking at what's the spread. Is the spread big enough to warrant paying the taxes? Mm-hmm. Or is the spread tighter? Well, and after paying taxes at the state level, I should have just bought the Treasury.
Well, okay. So, and the point of my asking was to get that answer that you just gave, which is to say it's a complicated deal, and it's something that you really. I don't know that I would want to do that kind of thing myself, because there's risk in these things. The risk, of course, I'm not going to say the biggest risk of bonds, but I think the most obvious risk of bonds is what you mentioned a little while ago, which is that if interest rates rise, your bond is going to lose value. And
from a tax planning standpoint, too, there's also the ability to look at it. So I found 2 bonds with the same maturity, with the same yield to maturity. One of them has a very low interest rate, and one of them has a higher interest rate. Which one in a personal taxable account would I want? They have the same maturity, they have the same yield to maturity, same return.
Mm-hmm.
But from a tax standpoint, I want the one that has the very low interest rate, because that's taxed as ordinary income, assuming it's a corporate bond, or even a treasury for that matter. Whereas the appreciation, because it's going to be selling at a discount, and so the appreciation is a capital gain. So I can mix in some capital gain and get some lower tax treatment.
Well, and try to find somebody who doesn't understand how these work. Try to find somebody who would know that, or would think that that's a better way to go, because it's not the way most people think. They just think, oh, higher interest rate is higher. It's better for me. These are the kinds of things that you got to think about when you're discussing bonds. Now, we said, I think I said this toward the beginning of this episode, sometimes bonds are not paying what you think they're paying. And we've seen this in the case of...
Well, that's when you only look at the coupon rate. Coupon rate is the interest rate. So I look at, and we talked about it earlier, it's like I buy that treasury that was issued a number of years ago and it has a 7% interest rate. So I'm going to buy a 7% bond in a 4% world. I'm getting better than anybody else. No, you do not have that kind of control. You may be getting a 7% interest rate, but you paid a premium for that bond, and your real rate of return is your yield to maturity. On the other hand, and this is something that we do explain and have to explain to people a lot when they see a bond in their portfolio that has a 1.25% interest rate, and they're saying, well, wait a minute, I thought we were getting 4% on these bonds. Well, we are, because today's current value is $89,000 on a $100,000 bond that matures in 3 years or whatever the number is. And so you're going to get that 1%, but you're also going to get 11% in appreciation over those 3 years. So the combination of everything gives you that 4% rate of return that you need.
Well,
but
and this
was
was
one factor that we're dealing with here.
Yeah.
We are not using the interest to live off of. We're using it as part of our return. It is not, in today's world, it's not the old days when you could just buy a bond portfolio, live on the interest, and have enough left over to reinvest for inflation for the future. We don't have that luxury of those high interest rates that we had back in the day. We have to be more creative, and we have to, basically, you have to do buckets. You have to have a portfolio with a portion of it set up that is basically risk-free, where you can draw principal and interest down for a period of 7, 8, 10 years, and leave the things that have volatility that have a better potential rate of return grow during that period of time. You're not looking to make the distribution on 100% of your portfolio. You're looking to make the distribution on a portion of it, and you're looking to reinvest all the interest and dividends and capital gains on the rest of the portfolio to offset what you're taking out in the early portion of the bond-only portfolio.
Yeah, and you know, we've said this before when we talk about buckets, and this is how it really relates, that all the research has found that if you spend the bonds first in your portfolio, meaning spend the I don't want to say non-volatile in this case, but spend bonds first, but do that before stocks. What do we really mean when we say spend bonds first, Rick?
We mean spend the principal and the interest of the maturing bonds.
Yes. I think that needs to be explained.
Well, I mean, like I talked about earlier, we have, if we have we want $50,000 a year. Maybe I'm going to ignore inflation right now and actually ignore the real return. But we put $350,000 in a bond portfolio. That isn't a long-term bond portfolio. It's not a 30-year. It's comprised of a 1-year bond for 50, a 2-year bond for 50, a 3-year bond for 50, a 4-year bond for 50, a 5-year bond for 50. Every year, $50,000 is coming due and turning into cash, and that's the cash I'm going to spend for that year. That's the bond portfolio. That's a laddered bond portfolio. It's laddering maturities, and I'm not taking any risk with that, assuming that the companies I'm buying or the entities I'm buying have the ability to pay. But that's spending bonds first. Typically, though, when you see a bond portfolio, a bond mutual fund. Now, bond mutual funds do categorize themselves as short, intermediate, long-term bond portfolios. And you have to understand the risks associated with those different bonds. The shorter the bond portfolio, generally the less in interest that you're going to earn. The longer the bond portfolio, generally, the more in interest. But the longer the bond portfolio, the more volatility there is in that portfolio from day to day, year to year. So we have to figure out, and also, as I said earlier, I don't want a super long-term bond portfolio for long-term. Because do I want to have what's a 30-year treasury right now? Maybe the high fours? Do I want to lock into a high 4 rate of return for 30 years? Or do I want to use the stock market for 30 years? Or 20 years for that matter? So it's just different games. But spending bonds. But if you put a bond portfolio together, you look at the Lehman aggregate bond, which is a very common index we compare to. It's a little bit of short, intermediate, long. It's a little bit of corporates. It's a little bit of treasuries. It's a little bit of everything. And it's designed to be managed as one pool of money. And it's really not designed for a distribution strategy because there is some variability to the principle of that portfolio. That if interest rates go up, that bond that I own, those bonds in that portfolio, goes down in value. And if I have to sell to be able to draw out some money to spend, that's a bad time to sell when the
well, it's
value
like selling
is down.
stocks when they're down. It's like selling stocks when they're down. It's kind of a reverse dollar cost averaging type of thing, but you can actually do that with bonds. Now, I know there's been a lot of, there's been some technical talk, and we've done all this stuff here, and it's kind of been like school a little bit because this is the professor teaching the class. But what would you say, Professor, is the takeaway for people here who kind of understand bonds? Would you say it's equally important for somebody to work with an advisor to with both their bonds and their stocks? Do you think it's more important on the bond side? I mean, I know I'm asking an advisor, but if you would, I know you'll give me an objective answer.
Well, there's a relativity to your thing. I consider myself to be kind of I can't remember the word you said. I kind of understand bonds. I am by no means an expert in bonds. And that's why I don't necessarily pick the bonds for the clients. I have pros who have access to all this do it for me.
Just like they do with the stocks. I
kind of understand bonds, and I understand bonds better than most.
Well, you understand. Well, what you understand is how they work. Now, the actual bonds, I'm saying, I'm not.
Yeah, I know how they work, and but what's available, what's going on. I know that if I've got a 1-year time horizon, I'm looking at yield to maturity, CD rates, yield to maturity treasuries, yield to maturity corporates, high qualities. And I know the person's tax bracket, so I know whether I'm even going to consider looking at a municipal. Now, there have been anomaly times in the history where, for whatever reason, municipal bonds paid higher interest rates than corporates did, which was a very weird time. This is back in the 80s. And I actually saw municipal bonds inside of IRAs.
Oh, man. Well,
it didn't make them tax-free, but it was a better rate of return for the same maturity, the better yield to maturity than for other bonds. It was like, well, why not? But you do need to know what you're doing with them more than just a cursory level. If I were building a bond portfolio, I wouldn't. I would have a pro do it.
Well, and that's the important part of this, I think, because with all these technical terms, with all the things you got to look at, the risks, the interest rate risk, the yield to maturity, understanding how the spread works, and how they're taxed, where they're taxed. We can get into asset location, which we're not going to do, and then there's also the nature of the bond. I don't want to get into it because we're about out of time, but we've talked about the idea of you're not necessarily getting what you think. I-bonds were a big example of that about 3 years ago. A
little more than that, probably, but yeah.
It was, I think, 2022.
2021 or 22. Yeah, 2022, yeah, 3 years ago.
Yeah, and there was a time when there was, I think, a 9% tag on that. Now, that is not what they were actually paying. But
it was what they were, the 9% return was what you would return for a year if you held it for at least a year, and you have to hold it for at least a year. And they didn't change the rate after 6 months, which they can do. And they did change the rate after 6 months because that's the way they work.
Yeah, and there were risks associated with people, but I haven't followed it since then because I don't.
And those 9% bonds that were issued in 2022 that didn't change down, the bonds that were issued a year later that were only earning 7%, or 6% were better than the ones that issued at 9%. Because they had a better rate going forward than the ones that were issued a year earlier, even though the beginning rate was a lot higher.
Well, remember, and this point, yeah, so and this points out, exactly why you need to understand what's going on. And we tried to do this during that I think it was about a month, where everybody just went nuts because we had no interest. We had 0% interest rates basically for 15 years, and all of a sudden you see this 9%. I mean, everybody was asking about it.
I bought some. Oh, yeah, I bought my allotment, and I held them for 1 year. And I
remember
got
that.
My 8.5% annual rate of return.
Annual
it was
rate
9.5 the first. It was an annualized 9.5 the first or something like that, the first 6 months, and then 7.5 for the second 6 months. So I got half of 9.5 for 6 months, half of 7.5 for 6 months, and then I cashed it in and took a 3-month penalty, and I still did pretty good.
Yeah, so
it was better than a CD I could buy at that time.
Yeah, and I won't get into the rules on those because there are very specific rules, and they're not, frankly, all that interesting. But this is something else that you got to be watching out for. So really, when you're talking about things like bonds, they're not as simple as just buying them and holding them. And as Rick said years ago, people buying them, living off the interest, and then reinvesting later on for inflation. There's a lot you need to do. There's a lot you need to understand. Or if you don't need to understand it, talk to your advisor. Rick, you and the advisors at Lucia Capital Group, one of the first things I learned about you years ago was that you were kind of the bond guy. Even before the Social Security guy, you were the bond guy.
Well, I knew a lot about treasuries. I knew a lot about the savings bonds. I knew a lot about the TIPS, Treasury Inflation Protected Securities. I knew a lot about the I bonds versus the E bonds and all of that. And so I was the go-to for the weird bonds, shall we say.
The weird bond. Well, we had the double E's, we had the double H's, or the...
Oh, yeah, back in the H's. Yeah, I forgot about those. We haven't had those for so long.
Well, because I dug some out. My kids had some from the 90s, in the late 80s when they were born. So anyway, but this is the kind of thing that you need to have your advisor go over with. And Professor Plum and any of the Lucia Capital Group advisors can help you out with this. It's not simple, and there can be consequences, serious consequences for not doing it correctly. So give them a call, 800-644-1150, 800-644-1150. Any of the advisors at Lucia Capital Group can go over this stuff with you. And it's probably helpful, as we did here, I hope we did here, to be educated somewhat on how they work and what the risks are. Because if you don't understand the risks, you may wind up buying something that is too risky for you. And obviously, we don't want to do that. So talk to the advisors. They can help you out and at least help you understand how this works, and put together a portfolio that may include some bonds that may actually work very well for you. 800-644-1150. You want to learn more about bonds? There's always stuff to learn. You can go to luciacap.com, LUCIACAP.com, type in bonds or interest rates, whatever you want in the search bar, and you'll get information that you can use, video posts, videos and blog posts and all that kind of thing. Also, speaking of search bar, type in the search bar retirement, you type in buckets, you type in any of that stuff, estate planning, you're going to be able to download our guides. We have each of those guides free for you to read. Go to luciacap.com and read those. Download them for free and read them at your leisure. And I do think you're going to get something out of it. I really do. This is why we do this. It's part of education, and education is a very, very important thing. luciacap.com. Type that into the search bar and download your guide. Don't forget, subscribe to this podcast, Apple Podcasts, Spotify. I remind you every single time. I want to remind you again here to do that because you don't want to miss a single episode. You miss an episode, you miss a lot, or whatever the actual cliche saying was. Professor, thank you you actually were a professor today. I mean, really.
Thank you.
I mean, in a way, you were kind of teaching a class today, but I appreciate it. Thank you very much.
You're welcome.
For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, podcast host Johnny Dean. That's me. Talk to you all again next week. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client or prospective client's portfolio. Thus, investments may result in a loss of principal. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. correctly. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Investing in mutual funds involves risk, including possible loss of principal. Fund value will fluctuate with market conditions, and it may not achieve its investment objective. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Series I bonds are guaranteed by the U.S. government as to the timely payment of principal and interest and offer a fixed rate of return and fixed principal value. Minimum term of ownership applies. Early redemption penalties may apply. Savings bonds must be held at least 1 year before they can be redeemed. If they are held for less than 5 years, a penalty of 3 months interest will be assessed when the bonds are redeemed. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Bond yields are subject to change. Certain call or special redemption features may exist which could impact yield. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.